When this shit goes, it's going to go very quickly. Before you are certain that a crash is happening, it may be already too late. Credit goes first, then bonds, then equities. Okay, so let's talk about the phases of a market crash. Because what's typical is a lot of people, they look at SPY and they think everything is fine. Well, the first thing that we're going to talk about is, and I usually I talk about when the crash is already happening, but let's talk at least about one thing when it's happening. Surefire way is prices go up regardless of negative news. Now, I know this happens with a lot of things, but I mean, really negative news and it just doesn't react. Absolutely doesn't react. Number two, old traders just don't get it, okay? So old traders, like people have been in the market for a long time. They just don't get it, man. They just like the future is crypto and the future is hydrogen powered soapbox derby cars that we send down a hill, or you just don't get Trump and his new SPAC, or you don't get GME and you don't get this. And you see a lot of new people doing really well. Those are signs that you know you're in a bubble. Lots of people getting rich real fast and you feel like you can't keep up with it. Who feels like they can't keep up with it? It's like a new paradigm. It's a new future. It's the metaverse. It's decentralized finance. It's the new thing, dude. So this is what I call plain euphoria. Okay, next. Number 3, credit is a leading indicator of market crashes. Declining credit quality. In the 2008 crisis, we saw all sorts of things like this. We saw people not being able to pay their mortgages. We saw people not being able to pay their credit lines. We saw people withdrawing credit. We saw big funds start to go bust. We saw credit spreads on credit default swaps widen. What does that mean? Well, the stock market is an auction system, meaning there are people who are bidding, right? You see the bid ask. There are people bidding to buy and people asking to sell. Okay, it might be news to you, but the stock market is an auction system. If you've ever seen an old style auction where you've got the auctioneer talking really, really fast, right? Either way, when bid and ask become wider, meaning there's not so many bidders, not so many people wanting to buy because they're unsure of prices or the stability and they keep just growing and growing and growing. That is loss of liquidity. So in the credit markets, which is very different from equity, there is a process called declining credit quality. You can see this on CDSs, or credit default swaps, which pay out when the underlying IOU or bond defaults. They even pay out, I guess, if you can find a buyer of your credit default swap, if you own it, they do increase in value as the credit quality of something decreases. Credit quality is a function of a better and bigger purse. So because if somebody else steps in and buys it, then it doesn't really matter, right? Which is exactly what we're experiencing with the Federal Reserve, right? COVID should have destroyed multiple businesses, but it didn't because of a Fed put. What was the Fed put? Well, they went out there and they bought bond ETFs and they supported the market in its time of transition and in its time of solvency crisis. So it's really a function of who can backstop it. If they buy every bond, then what credit crisis really is there? So it's important to watch the Federal Reserve and understand their impact on the market. But this is a general one, right? So declining credit quality. Steps 4, you will see bigger funds, people go bust. As Warren Buffett said, You never know who's swimming naked until the tide runs out. Well, if you start to see people bust real quickly, it's kind of a sign. Okay? So let's talk about who's gone bust this year that are big funds that have been around for a while. Greensgill Bank, SoftBank subsidiaries, and now SoftBank is in trouble. That was earlier this year. Now SoftBank is in trouble. Archegos, Tiger Fund, Evergrande. The Chinese property sector makes up a fourth of their economy. They are now the wealthiest country on the planet, even with the declining value of their real estate. They accomplished that just 2 weeks ago. It is no longer the U.S. Now, that's when I checked last week. Maybe we're competing for head, but the world is changing, and you need to watch it. Number 5, after the credit goes bust and you see people go bust, next you see bonds come down in value. Okay? So one thing that you know is when a bond is less than $1 per par, that they are bankrupt. Either way, when you see the declining value of bonds and the increasing value of yields go up, that's another sign that there's an impending crash. Why? Because investors are demanding more yield to hold that bond. You must have gains to offset your losses, and that's exactly what they're doing in a rational sense. As people exit out of bonds and buy more credit default swaps, there's a very specific thing that happens, which is they get into the bonds, they get into the credit default swaps, and to hedge, they short equities. So when you see the volatility of equities start to rise, that's definitely another top indicator. Remember, let me say that again. When people have to hedge out credit or the declining credit quality, what do? They hedge by shorting equity. So it is literally like a whip. When they hedge to short equities, what'll happen is the increasing volatility will go like a whip and snap, right? What is exactly a whip? Well, the end of the whip is literally traveling faster than the speed of sound because it makes that crack, right, at the end. But yet it is still not a forceful event except at the end, which is exactly where equities lie. That's why you see such huge movements, is because to hedge out bond risk, they literally will short equities. And so you'll get just a huge escalating volume. When this shit goes, it's going to go very quickly. So what's going to be really telling is when good quality stuff starts to decline in price outside of its normal trading prices, because people sell what they can, not what they want to. So at the last portion, equities start to go. After equities start to go, the next thing you'll start to see is withdrawals being limited. They will stop you from pulling out your money because it will threaten the viability of organizations or institutions. Before you are certain that a crash is happening, it may be already too late. What are signs of this already happening? Okay. So we have the entire Asian property sector in a little gully. Right now, as far as the reduction in credit quality, 1/4 of all installment loans, those buy now, pay laters, are delinquent. Energy providers in Europe are going bust all over. We are using, across all brokerage accounts, we are using 208% of our cash versus margin. That is higher than the 2000s. So in all brokerage accounts, and yes, you can look at FINRA data, you can see that we are at a higher margined level than the 2000s. We have the biggest fiscal cliff in all of history. 17 million have already gone through the eviction moratorium, which was back at the end of summer. Millions of people were moved off of financial support as of COVID. We have inflation rising to 6%. We have PPI, which is producer price inflation, at 8%. And we have intermediate producer inflation at 27%. Numbers not seen since 1970. The inflation print was on Friday. Well, and intermediate and PPI are considered leading indicators. Savings accounts have started to go down, and revolving credit is starting to be used. What is revolving credit? That's credit cards. So they're out of money and they're on credit. No, unemployment was worse than expected last Friday. Another thing that you'll see energy go up in price prior to a deflationary event or a crash. Just go look at 2008. You'll see. The last and most worrying factor is that our government continues to push government mandates on us. And I know that may be political in nature, but you need to separate yourself from that and understand that we're having labor shortages, which make companies unable to produce and supply the things to make their revenue projections. We have already seen very large companies come out and say that they missed their revenue projections because of labor shortages. So if we're having government regulation not help the situation, it could turn out very poorly. For example, Apple came out and said that they will not be able to produce an extra 10 million iPhones. Okay, each one of those iPhones go for like $1,000. That's a lot of money that can't be produced. Chicken has gone up because they can't even get. Do you know that we're in a tendie shortage? Do you know that we are in a chicken tender shortage because we do not have the people? Increasing regulatory concerns definitely can crash markets. Regardless of your political background, there are people who do not agree with you and will not come back to their jobs. It is a fact. So hopefully you see the declining credit quality, which is CDSs in China are at the most that they've ever been. CDSs across most tickers are up. Yields on bonds have been escalating for a while now. Just zoom out on the 10-year, the 30-year not so much, 2 and 5 year. Credit goes first, then bonds, then equities. That's how it happens. Thank you for coming to my TED Talk. Remember, guys, if you're watching on YouTube, I have a Twitch stream. Come by, hang out in the Discord, maybe sub. I want you guys to come in, interact. Hopefully you learn a little bit something. Maybe you can teach us something. Who knows? Either way, come by. I'd love to talk to you guys. I respond to every message, so please come around.